The signs were everywhere, but now it's official. We are in a recession. The research group that makes that determination made it today and said the recession actually started a year ago. But the question now, when will it end? Wall Street is clearly worried. The Dow plunged nearly 680 points today, or 7.7%. Anthony Mason is our business correspondent. Anthony, last week's big rally is now just a fond memory, isn't it?
What the market giveth, the market also taketh away, Katie. Remember that historic five-day rally, the biggest since 1933? Well, it ran into a bear today, and in one big bite, more than half of those gains were gone.
Market crashes are extreme and frequent, and a single crash can wipe out years' worth of gains. For example, pension funds lost up to 40% of their net assets in the 2008 financial crisis. As a result, retirement income for young people in many countries is no longer guaranteed. This problem can be mitigated by improving the accuracy of market forecasts. If a crash can be predicted, it can be prevented.
To understand how the market forecasting can be improved, let's look at how the market functions. In a free market, each individual analyzes its own information to form opinions about the future, and determines its demand for available assets to fulfill future needs. Hence, each individual translates its information about the future into the price at which the individual is willing to buy or sell an asset. Because these assets are traded across a large number of individuals, these asset prices end up aggregating information scattered across all market participants, and provide the most informative view of the future.
However, uncovering these future expectations from asset prices is incredibly challenging, with no satisfactory solution available. Our proprietary research combines latest advances in data science and financial economics to develop the best available solutions to extract the market's expectations about future growth, risks, and the market's own preferences, information that is critical but not otherwise available.
As asset prices fluctuate constantly, and so do the implied expectations about the future. Therefore, we use artificial intelligence to deconstruct these price-implied expectations into various layers, based on their informational content and accuracy, and recombine the most informative and accurate layers to generate our future forecasts.
Combined, these financial, economic, and AI models distill the market's collective knowledge about the future, which allows us to peer into the future through the eyes of the market, and improve forecasting accuracy by more than an order of magnitude.
This indicator tracks the forward-looking expected price level. In theory, the observed price should stay close to its expected level. But every now and then, price expectations collapse, creating a divergence between expected and observed price levels, and the observed price inevitably converges to the new expected level, allowing one to predict the direction of observed price movement. Similarly, in December 2018, when the observed stock price falls sufficiently below its expected price level, it eventually moves up considerably to catch up with the expectation, allowing one to predict the strong recovery at the beginning of 2019. As a result, this indicator predicts all major S&P 500 crashes and subsequent recoveries since the beginning of 2018, with no incorrect predictions, a feat unmatched by any available product.
For example, let's look closely at the February 2018 crash. Model implied price expectations crash on January 29, 2018, and the observed S&P 500 price starts crashing beginning February 2018, allowing one to predict the February crash at the end of January. A similar pattern can be seen in May 2019 crash. Model implied price expectations crash in March 2019, and the actual S&P 500 price collapsing in May and June 2019, allowing one to predict the May crash in March.
This indicator provides a forward-looking measure of turbulence. Because turbulence in the market is generally associated with downturns, a spike in the indicator implies a higher likelihood of a downturn. As a result, this indicator serves as a reliable warning signal for a potential downturn in the coming days, and predicts 8 crashes from January 1, 2018 until the end of July 2019.
Now, let's look at some longer-term forecasts. This is a longer-term forecast made on October 31, 2018. This forecast uses data from 1st of January until October 31, 2018 to train the models, and forecast the S&P 500 price from October 31, 2018 until the beginning of 2019, and, as can be seen, The resultant forecasts pick the dip in December 2018 as well as the subsequent recovery, both of which were largely unpredicted by most economic forecasters.
Similarly, this next longer-term forecast is made on April 15, 2019, which uses data from January 1, 2018 until April 15, 2019 to train the models, and forecasts the S&P 500 prices from April 15, 2019 until the end of July 2019. This forecast correctly anticipates the drop in S&P 500 price during May and June 2019, and the subsequent recovery during July 2019.
Marketojo, the market's eye view of the future.
Marketojo offers the most accurate economic forecasting tech, enabling better investment decisions, by distilling the market's collective knowledge of the future, improving forecasting accuracy by more than an order of magnitude.